All righty, let's get started. Hello, everyone. Welcome to today's webinar, which is Unraveling the Mystery of Index Annuities and Income Riders. I'm Lloyd Silver of Gateway Insurance, and I'm delighted we have such a large group with us today. Before I begin, I do want to emphasize that everything I say today is my opinion, not any insurance carrier, not any broker-dealer, just mine. I mention this because I'm sure that I'm going to be saying something that others might not necessarily agree with. It might even be considered slightly controversial. Also, no part of this webinar has been submitted to any compliance department. I'm comfortable with that in this environment, but please make sure that you check with your own compliance department before using any of this material with your clients. If you have any questions, please type them in the chat box. We've got a lot of people on the webinar, so we've muted all the phones, but I will do my best to answer every question. If I see one that might be more appropriate later in the webinar, I'll hold off on it. Otherwise, I'll try to hit them at appropriate spots during the webinar. So let's go ahead and get started. First, let's take a look at what we're going to cover today. We're going to start with a short history about index annuities, and then I'll go into a bit more detail on the various components of an index annuity. We'll take a look at a couple of the most popular index crediting methods, and then spend a fair amount of time talking about guaranteed withdrawal benefit riders, also known as income riders. And then we'll conclude by taking a look at the current index annuity landscape and talk about some of the best-selling products in the marketplace today. So that's the plan. But again, if you have any questions, we're here for you, so please feel free to ask away. The title of today's webinar, let me just quickly go through this one more time, sorry. So the title of today's webinar is Unraveling the Mystery of Index Annuities and Income Riders, Not Solving the Mystery. I'm going to do my best to demystify some of what might get in the way of agents selling and consumers purchasing these products, but there's still a lot of options out there. So it's important to work with a company like Gateway who can help you navigate through all of these products and help you select the right one for your client. Now, here's the first thing I'm going to say that might be controversial. Index annuities are unnecessarily complicated. What do I mean by that? Quite simply, an index annuity essentially is just a commodity these days. Almost all of them fundamentally work the same and more or less are going to produce similar results. But insurance carriers want you to think that their annuity is different, that it's special. In some cases, carriers are able to do things that, in fact, do make their annuity just a bit different than the carrier next door. But more often than not, what you hear is simply marketing hype. Again, this is just my opinion. I know some carriers would argue with me. I'm not trying to take away from some of the special features and riders that they offer, but much of what makes index annuities so complicated is simply carriers doing whatever they can to get you to sell their product and not someone else's. With that said, let's take a quick look at the history of index annuities. It all started back in 1995 with Keyport Life, and Keyport is now part of Sun Life. They were a top variable annuity carrier, and they wanted to create a product that combined the benefits of variable annuities, mainly the ability to participate in index gains, with the guarantees of traditional fixed deferred annuities. Thus was born the index annuity, which did exactly that. It offered some index upside potential, along with the guarantee that the client's account value would never decrease. Back then, the typical crediting method was a 10-year S&P 500 monthly averaging technique. 10 years, meaning that no index credits were applied to the policy until the end of that 10-year period. Now, like today, those policies offered 10% annual free withdrawals, and index credits were only applied after that 10-year period to the account value at that time. So in many cases, the annuitant had withdrawn all or a major portion of their annuity and received very little income credits. So this method of crediting was quickly abandoned, and what we see today was the outcome. Let's look at what the market is actually asking for, because this is what's really driving index annuity sales. First of all, baby boomers are absolutely terrified of losing their principal. They'd like to earn some gains, but even more importantly, at least as a group, they don't want to lose what they've worked so hard to build. On top of that, a little while ago, it was about a year ago, in a Time magazine article, it was declared that the first human that will live to age 150 is walking the earth today. Talk about amazing longevity. So baby boomers don't want to lose money. People are living to extraordinarily old ages, And this has now developed into the number one fear of Americans, even greater than the fear of public speaking, which is the fear of outliving their retirement savings. And it's these conditions that make index annuities such a fantastic option for the right clients in the right circumstances. In fact, today, over 40 carriers are offering index annuity products, with over 250 of those products in existence. In 2012, almost $34 billion of index annuity premium was sold, which was a 5% increase over 2011, making index annuities the fastest growing product in the life insurance industry. We take a quick peek and see if we have any questions so far. All looks good. So let's now move on and delve deeper into index annuities. I presume that most people, sorry, one second. So I presume that most people know what index annuities are, but here's a real simple definition. They're a tax-advantaged vehicle that allows for the annuitant to participate in upside index growth while eliminating any downside risk, offering both accumulation and income options. Now, I do want to caution people that I absolutely do not recommend positioning index annuities as an equity market alternative. While they allow for participating in upside market growth, they really aren't an alternative to stock market investments. And it's that comparison that we were all doing that caused increased regulation and compliance issues over the past few years. So we'll talk more about how to position an index annuity later, but I want to emphasize today that I don't believe index annuities are a direct competition to anything such as a stock market investment. Let's take a look at cap rates. It's one of the most common provisions you'll see in index annuities. A cap rate is the maximum index increase over a specified period of time used to calculate the index crediting rate. So here's what I mean. If the underlying index is up 10%, and in all these examples, we're assuming the cap rate is 5%. So if the index is up 10% and the cap rate is 5%, the annuity will receive a 5% index credit. 5% is the cap. That's the maximum amount that can be earned. Now, if the index is up 5%, the cap is 5%, then still 5% is credited to the policy. But if the index earns less than the cap, let's say 2%, then that's what's credited. And of course, if the index is down, the account value does not decrease. Now, one question I'm asked quite frequently is why index annuity cap rates are so much less than index universal life cap rates. This is actually pretty important because it explains how carriers manage these policies. With an index annuity, the carriers take somewhere about 96-97% of the premium that they receive, and they invest it in low-risk bonds that match the length that they expect the annuities to stay on the books. The rest of that premium, another 3-4%, they buy options. They buy options on the indices that are being used, and that's what allows for both the upside potential and protecting the account value from decreasing. So if the carrier invests in bonds, and let's say they earn 4%, and they need to earn at least 1% to pay all their bills and make whatever profit they need, that means they need to set cap rates so that they pay about 3% on their annuities over that time frame. And I'm just using these numbers as an example. In high interest rate environments, these numbers would be higher. Even today, these numbers may be slightly higher than they are. But the bottom line is they earn a certain rate of return. They know how much they need to make in terms of profit off of that return, and the balance is what they can afford to pay to annuitants. And they set all their cap rates and all their participation rates and spreads, and we'll talk about those in a second, accordingly. Now, with an index universal life policy, in addition to earning those spreads, they have premium loads, they have policy fees, per 1,000 charges, administration charges, lots of different ways for them to make a few dollars. So what they're actually doing on index life policies is subsidizing those cap rates, and they're offering a higher cap rate than they would be able to if looking at the investment spread alone. So that's a big reason why we see such high cap rates on universal life index policies, average today probably somewhere around 11%, versus a cap rate on an index annuity, which somewhere around 3 to 5%. Let's move on to participation rates. This is simply the percentage of the index change used to calculate the crediting rate. So let's say that the index is up 6%. If the participation rate was 125%, and there are some policies that have participation rates of over 100%, then 6% times 125% equals 7.5%, and that would be credited to the policy. If, on the other hand, the participation rate was only 75%, then 4.5% would be credited to the policy, which of course is the 6% index return times the 75% participation rate. And the last major component here is spreads. Spreads are a deduction from the percentage of index change used in calculating the index interest each year. So let's say the index is up 6% and there's a 2% spread, then the annuity would receive a 4% credit. If instead the spread was only 1%, then it would receive a 5% credit. So that's caps, participation rates, and spreads. The bottom line is that all of these are simply methods of doing exactly the same thing. These are simply ways that allow the insurance company to offer upside index potential while allowing them to provide the guarantee that no principal would be lost. But they all do exactly the same thing, just in different ways. And here's another likely controversial statement on which method you should choose. In my opinion, it just doesn't matter. In the long run, over any sustained period, whether you choose a strategy with a cap rate, a participation rate, or a spread, will result in approximately the same outcome for the client. Insurance carriers are risk management companies. They aren't offering choices that could materially impact their results. They want predictability. Yep, over a short period of time, there will very likely be a difference in results depending upon which of these methods you choose. But if we're talking about a longer-term savings vehicle, like hopefully you're presenting an index annuity, for most of us, in the end, what we choose just doesn't matter. Now, one point I really want to emphasize is that you need to take a look not just at the current rate being offered by the carrier, but their guaranteed rate as well. All carriers offer products where they could substantially change what that rate is at each contract anniversary. Whether it's a cap rate, whether it's a participation rate, whether it's a spread rate, they can change it at various times during that contract period. And by change, I mean more often than not, they could lower it. There have been examples when carriers have actually increased those rates to make their products more competitive. But more often than not, we've seen, at least in the past few years, carriers that are decreasing these rates even as early as the second policy year. So it's especially important that you also check the renewal rate history for the carrier. Do they have a solid track record of renewing rates at levels similar to the original current rate? And this is something I actually didn't know until recently, as I was looking into this a little bit more carefully. But only about a dozen carriers today publish their index annuity rate renewal history. For those carriers that are not publishing that history, why? If I were selling a policy, this is something I would really, really take into consideration. I want to see what these carriers are renewing their rates at and be comfortable that my client is going to get a renewed rate equal to, or at the very worst, just slightly less than what that original rate was. So lastly, let's take a look at the reset provision. This is what gives us our downside protection. And typically, the reset is on an annual basis, but there are some products that offer longer time periods. Well, they'll do a reset, for instance, after the second year. I've even seen ones that go up to 3 or 4 years. This is basically when whatever index credits we've earned have been locked into our account value forever, and that we'll never be able to lose. Let's take a look at this chart. We can see that in the first year, the index was up. And so the reset happens after year one, and we lock in all the gains that we achieved in that first year. In the second year, the index was also up. And so once again, at the end of year two, the annual reset provision, in this case, we're assuming a reset every year, that kicks in, and we've now locked in all of the growth to date. However, in the third year, that index takes a tumble. And this is, of course, the beauty of an index annuity. Even though the index went down because of the annual reset provision, all of our previous gains have been locked in, and they are not subject to any type of loss. So our account value stays the same despite the fact that the index value went down dramatically. And this, again, is the beauty of an index annuity and what is very attractive to a lot of people. I'm going to check again for questions one more time. Looks like we're good. Again, feel free to ask any questions. I am taking a look at them periodically, although every time I check, it does cause me to have to go back a little bit in the presentation, but hopefully we'll be able to move forward there. So we take a look at cap rates, participation rates, spreads, annual resets. These are all the major provisions that you'll see in index annuity. Let's now take a look at crediting methods. Now, the most common index used is by far the S&P 500, but today there are about 20 different indices that clients can choose from. We've got foreign indices, we've got a couple of bonds, we even have a commodity index with the London Gold PM that several carriers are using. There are some strategies that allow the client to choose a blend of those indices, and sometimes these carriers get fancy. They may have an option where there are 3 or 4 different indices that the client is essentially putting their money in. Yet at the end of the year, they'll remove the worst performing and do lots of crazy math to come up with whatever the index return is. There's also often a fixed account, similar to what would be seen in a regular deferred annuity if clients want to put their money there. And again, I'll have to say this, it just doesn't matter. If we look at all the various indices that are out there, and should I put my money in the S&P 500 or the Russell or the Dow or the NASDAQ, at the end of the day, again, insurance companies, the risk management companies, all they're trying to do is make a predictable rate of return. It's all about risk mitigation. So they're going to adjust their caps, they're going to adjust their participation rates and their spreads to make sure that they pay out whatever they need in order to earn whatever it is that they need to earn. In the short term, the index choice may make a difference. Obviously, if one index is up and another is down, if you were with the index was up, it's better for your client. But over the long run, all the carriers price all of their options very similarly so that the end result is fairly equal regardless of what you choose. Mostly, this is just a way for carriers to artificially differentiate their product. I'm not trying to offend any of the carriers. We often need stories that we can tell when we're sitting down and talking with clients. We want to tell a story about why one product is better than another product. And these sometimes help create that kind of a story that might make the difference between a client doing nothing and making a wise decision by putting their money in what we think is most helpful for them. But again, at the end of the day, this is just a way for these carriers to offer some very slight differentiation of their products. Then the most common index crediting rate is by far the annual point-to-point. It's very simple to understand and explain, which is one of the reasons why it's so popular. It's also one of the oldest index crediting rates, which came into existence quite a few years ago. All you do is take the index value at the end of the contract year, you compare it to the value at the beginning of the year, and then the percentage of change is calculated. If the ending value is higher than the beginning, you receive index interest, subject to the cap rate, the participation rate, or the spread, depending upon what that product offers. If the ending value is lower, then nothing is credited, but the account value doesn't decrease. So here's a simple example. The initial value is 100. We can see that over on the left-hand side. The ending value is 107. So that's a 7% change. If the product has a 5% cap, then a 5% index credit would be applied. If instead of a cap, the product had a spread, and let's say the spread was 2%, then you take that 7% earned, you subtract the spread of 2%, and again, we'd apply a 5% index credit. If instead of a cap rate or a spread, this particular product offered a participation rate, and that rate were, for example, 60%, we take the 7% index change, we'd multiply it by 60%, and that would give us a 4.2% index credit. So very simple to understand. We're just taking the values at the end of the year and the values at the beginning of the year, and from that, we can do our calculation. Clients typically get this. They understand it. If they can understand it, then it makes it a heck of a lot easier for us to sell it. Now, the second most popular crediting method today is the monthly average. This method helps reduce volatility by averaging the monthly highs and lows over the course of the year. The index values at the end of each month are tracked for 1 year. At the end of the year, those values are all added together, then divided by 12 to determine the monthly average. And from that, we can do a little bit of math, and that's going to give us what that change was for that particular index. And of course, that change is subject to caps, spreads, and participation rates. So here's an example. In month 1, at the end of the month, whatever this fictional index, the value of that index is 103. At the end of the second month, it's 102. At the end of month 3, it's 104, and so on down the line for 12 months. I take all of those ending index values for each month, we add them up, and we get 1,239. We take that 1,239 and divide it by 12, we get 103.25. From there, we subtract the starting value, which was 100, from this monthly average value of 103.25, and we get 3.25, which when divided by the initial value gives us a 3.25% index change. So if we had a cap rate that was 3% and the index change was 3.25%, of course, all we get is the maximum up to the cap rate of 3%, and that's credited to the policy. If we had a spread of 2%, we take that 3.25%, subtract 2%, and that would give us 1.25% credited to the policy. And lastly, if we use the participation method, and that rate was 40%, we would take what the index change was for the year at 3.25%, multiplied by the 40% participation rate, and we get an index credit of 1.3%. So the monthly average, certainly a little bit more complicated than the annual point-to-point, but it's still fairly easy to explain, and clients seem to like this method as well. It's incredibly popular. Now, the last method I'm going to talk about today is a trigger method. It's fairly new, but it's incredibly simple to understand, probably the most simple out of any crediting method. And in my opinion, simplicity is the key when we're talking about selling index annuities. So the way the trigger method works is if the ending index value, and again, this trigger could be applied on any index, although what I'm seeing right now is the S&P 500 over a 1-year time period. But if the ending index value is higher than the beginning, then you get whatever that declared trigger rate is. So let's say the trigger rate that's declared is 5%. And again, this is not a guaranteed rate. We have to look at that. That rate could be lowered after that first year. But let's say it's 5%, and the index is up 20%. Well, you get the 5% trigger rate. Let's say that instead of the index being up 20%, it was up only a fraction, up 0.1%, right? Just 10 basis points. It's still positive. As long as it's above the beginning value, you get the trigger rate, so you get 5%. Incredibly easy to understand. If the index is up, you get the trigger rate of 5% in this example. If the index is 0 or down, the account value stays the same. Simple to understand, simple to explain to clients. In my opinion, this is something that you should be taking a look at, because if we can make it easy for our clients to understand it, then likely our chances of making a sale and getting them into a product that helps them goes up dramatically. Now, there are about 17 different crediting methods out there today. That's actually much less than there were about 10, 15 years ago. Back then, we had over 50 different crediting methods. The reason being is that interest rates were higher, so it offered a little bit more flexibility in how we could determine some of these things. But still, 17 or so different methods out there. What method you choose in the long run, in my opinion, it really doesn't make a difference. Again, this is a common theme. In the short term, yep, there could be a difference based upon what method you choose. But over time, these are all going to work out to be the same. So you need to choose a method for your clients that's easy for you to understand easy for you to explain. Keep it simple. Now, of course, there are some very hot products out there with fairly complicated crediting methods. They're great products. I'm not suggesting you don't sell them. As long as you can fully understand and explain to your clients how those products work and you can be able to tell their story, absolutely consider them. But I think for a lot of us, simplicity is key. I'll take a quick peek, see if we have any questions. We don't, so I will continue on and talk about what I think is really the key here, income riders. It's one of the strongest reasons to purchase an index annuity. Incredibly popular. It became more popular just a couple of years ago. It was about 2-3 years ago. We could look at the top cap rates on index annuities, and they're about equal to the guaranteed rate on a 5-year MIGA, a multi-year guaranteed annuity. So why would you buy an index annuity where at best, if the index is up every year, at least equal to the cap, you do no better than what would be guaranteed in that 5-year MIGA? It just didn't make sense to buy index annuities back then. So carriers started developing income riders and some other riders to make their products a little bit more compelling and give people a reason to buy them, despite the fact that the cap rates were so low. Now, fortunately, cap rates have gone up in the last year. Now we can find cap rates of 5% and higher, certainly higher than MIGA rates, which are 2.5% to 3%. So there's now the original reason of buying an index annuity, that being long-term accumulation, is still there, but income riders have become incredibly popular. And in fact, today, 60% of index annuities are sold with an income rider. Incredibly popular, and as we'll see, they solve a really important problem. Now, income riders did not start with index annuities. They started back with variable annuities in 2003. And I'm guessing some of you, probably quite a few, were in business back then. And you might remember that a few years later, a few years after 2003, we had a pretty big crash back in 2008, I believe. And these income riders created a huge problem for carriers. Variable annuities are not sold with any downside protection. So there were many people whose account values were down 30 to 50% from their initial purchase. But they had an income rider. And that income rider offered a value higher than their initial premium and much, much higher, in some cases more than twice as much as the account value after that market decline. So there was a huge run on electing to take that income from these riders. And the variable annuity carriers were simply not prepared. They didn't price their riders accordingly. They couldn't handle the run. And there were major problems created. And several carriers had incredible financial problems that created a real rift in the industry. But with index annuities, we don't have the problem of account values possibly being lower than premiums paid. And income riders on index annuities are often priced much better than their variable annuity counterparts because of that. Because there's not a risk that there's going to be a huge run on taking income from these products because of a market decline. The carriers are able to price the riders on index annuities a little bit more competitively. So more and more agents are turning to index annuities today to give their clients access to this rider, whereas in the past, variable annuities were a bit more popular. Now, the most official, still generic term used to describe what we're talking about is a guaranteed lifetime withdrawal benefit. And this is basically a rider or an endorsement that guarantees periodic income withdrawals for a lifetime, even if the account value goes to zero. And I will be going into an example to show this. Now, do keep in mind that there's a fee for the rider, and that fee does reduce the account value. So you certainly don't want to put an income rider on an indexed annuity unless the annuitant actually wants that income down the road. At the very least, they want to have the option for that income. Otherwise, we're just adding a rider and a fee that goes along with it, which will reduce that account value versus not having the rider on it. Now, the first component of the rider is the benefit base. This is incredibly important. It's a shadow account that is what the guaranteed lifetime income is based upon. It's incredibly important to remember that, again, it's a shadow account. It really doesn't exist. It's not available for withdrawal. It's not available for surrender. It only applies if the lifetime income feature of the rider is turned on. And I know a lot of agents have gotten in trouble because of this, that they didn't adequately explain this concept to their clients, and their clients mistakenly thought that the shadow account was available should they surrender the policy, only to find out that that wasn't the case. So make sure when you're selling index annuities that you do a very thorough job of explaining this. Next, we have the benefit base rate. And this is the percentage the benefit base, the shadow account, increases each year. So it's a declared rate. It could be 5%, it could be 7%. I've seen them at 10%. It could be on a simple basis or a compounded basis. And it's usually for a specified period of years. So it would be, for instance, a 10% increase each year for 7 years. Now, there are some products that will allow the annuitant to renew after that first initial period is over. So after that first 7 years, for example, they could renew for an additional 7 years. But more often than not right now, whatever that period is, that's it. So after that time period, the benefit base rate no longer applies, but depending upon the product, there might still be some ways for that benefit base to increase. For example, if the index goes up and there are credits to the account value, those account value credits would also be applied to the benefit base. But it's important to keep in mind that the sexy number that we all hear, the 7%, the 10% number, that's only for a certain period of time. And I also caution you not to explain this to your client that they're getting a guaranteed rate of return of 7% or 10% for that time period. It's true in the sense that the shadow account is guaranteed to go up by that amount each year, but it's really not a true comparison because it's only available, once again, when income starts coming out. We have to take the income part into equation as well. Now, the payout percentage is the percentage of the benefit base that's paid out each year. It's usually based upon the annuitant's age when income starts. So the longer the annuitant waits before they start taking income, the higher this rate goes up. And again, I do have an example I'll share in just 1 second. So most carriers have 5-year bands. So that would what that would mean is that the payout rate would increase at age 60, 65, 70, and so on. So if the client is 60 and they wait until 64, and there's a 5-year band, they would actually be getting the same payout at 64 as they would at 60. So waiting that 4 years would make no difference in increasing their income. There are some carriers that have 1-year increases. So if you have a client that wants, for example, to start taking income out at 73, then you might want to consider looking at a product that has a 1-year increase in their payout percentage. That might, in fact, be better for that client. Most have an option to pay the income out for not just a single lifetime of the annuitant, but also for a joint lifetime, although at a reduced rate. And all of that makes up the guaranteed withdrawal income benefit. And this is the guaranteed income for life that's paid to the annuitant. It could be paid to the annuitant on just the annuitant's life, or it could be paid, like I said, on the life of the annuitant and a joint annuitant. Now, this payment, this is where we start getting into some real benefits of this rider. It's incredibly flexible. In most cases, it can be stopped or started whenever the client desires. And additionally, what happens is that these payments normally reduce the account value. What I mean is if the account value at the time the income starts is $100,000 and the client takes their first $5,000 of income from the rider, the account value goes down by that $5,000, so it's now $95,000. But the account value is still there. So let's say the client had an emergency and this was the only place that they could actually go to get money, it's still an option. They still have that account value. They can still tap into it. Now, of course, if they take out money from that account value, it's going to decrease the future income that they would get, but the flexibility is still there. And clients like that. They love the flexibility. Additionally, if the client dies while there's still a balance in that account value, that value is paid to the beneficiary. So if in that example, the account value starts at $100,000, the client gets that first $5,000 of income, the account value is now $95,000. We're just assuming income for one person's life. They pass away. The account value is still there. So that $95,000 will get paid to that beneficiary. Now, keep in mind, these provisions do vary from carrier to carrier, but pretty much unilaterally, they all offer a tremendous amount of flexibility. Now, this is one thing interesting to note, that even though we have this index annuity with an income rider, the client still has the option to annuitize the account value. By annuitization, of course, we mean taking that account value and turning it into some type of an income stream. For instance, it could be an income for life, just like what the rider is paying. And in fact, in almost every situation, if the client annuitized their index annuity versus actually taking the income from the rider, they'd get more money. So if we look at an annuitization of a deferred annuity based upon the account value, even though the account value is much less than that benefit base, that lifetime income stream would be, in most cases, higher than the income stream generated by the income rider. But clients hate annuitizing. Only 2% of deferred annuities are ever annuitized, whereas already we've only had these products out for really a few years in terms of being incredibly popular. About 12% of annuity index annuities that were sold with income riders are currently paying income. So clients are not only buying the product with those riders, they're taking advantage of the rider. The clients love the flexibility that this rider offers, much more so than annuitization. They'll give up a little bit extra dollars for that flexibility and also for the fact that that account value is still there so that they can take it out in an emergency, and upon a premature death, the account value would be able to pass on to the beneficiary. Let's look at a quick example. So in this situation, the client puts $100,000 into the index annuity. Right now, we're looking at the account value. So they put in the $100,000. For the sake of simplicity, we're going to assume that there is no growth in this index annuity. Absolutely, I would say not likely a scenario, but just for the sake of simplicity, no growth. So the index is either zero or negative every year. Now, there still is a guaranteed minimum, and let's say that that minimum was 1% per year. You can check with us, and we can tell you what the minimum is for each of these products. At the end of 10 years, the client would have $110,462 with which they could do whatever they'd like. At the same time, they're buying the income rider. So they put in that $100,000 initial premium. And let's say in this example, the income rider is paying 7.2% per year for 10 years. I'm using 7.2% so we can use the rule of 72 to make the math really easy. So after 10 years, the benefit base is $200,000. Again, this $200,000 can only be used for taking income for the rider. That's it. Can't be used for surrenders or withdrawals or any other purpose other than electing income from the rider. Now at age 65, the client would be able to normally take, and again, this varies from carrier to carrier, but quite frequently at age 65, the payout rate is usually about 5% on a single life. So they would take out, they would be able to get a $10,000 a year guaranteed income for life. So each year they get $10,000. Their account value, which if we assume was about $110,000, will go down by that $10,000 every year. So after 11 years, there would be no account value left. However, it's a guaranteed income for life. so they would still be able to get that $10,000 a year for the remainder of their life. Now, of course, uh, once the account value is depleted, there's no value for them to tap into in the event of emergency. There's no funds that are going to go to a beneficiary. But the whole point of this was providing the guaranteed income for life, and they're going to get that in the amount of $10,000. Or, as an example, maybe they want it for the life of themselves and their spouse. And normally, if a 5% payout for age 65 for a single life, we'd see about a 4.5% payout for a joint life. So for their two lifetimes, they would be able to get about $9,000 a year. And again, the client can start and stop the income as needed. They still have access to the account value. And upon death, any remaining account value would go to their beneficiary. In my opinion, this is the absolutely perfect product to help overcome that number one fear, which is the fear of outliving retirement savings. Let's start wrapping this up a little bit by taking a look at the index annuity landscape today. So I think there are three primary target markets that we need to be looking at. There are people who are looking for alternatives to CDs and medium-term investments like 10-year bonds. The rates are very low. If we look at the cap rates on index annuities, they are far greater than CDs, and they are greater than 10-year bond, like U.S. Treasury 10 years. So the upside potential is there. It's a great alternative to folks that are perpetually renewing their CDs. And in a minute, Jessica is going to talk about some of the products. And there are products that are really designed, for instance, for that CD alternative, where there is the guarantee of principal whenever they'd like, and other types of minimums to really make it attractive for your clients that are continuously rolling over CDs. Another market is certainly people that want a guaranteed income for life. Again, 60% of index annuities sold today have the lifetime income rider attached to it. This is a huge benefit. And if you look at folks like Tom Hegna, if you look at the Wall Street Journal and Forbes, they're talking about this guaranteed income for life as a real necessity in the planning that we're doing for clients. Social Security may not be around, pension plans are not common, but what we have is an annuity that can exactly accomplish the guaranteed income for life, and nothing else out there can do it like an annuity. And the third market is a way to add diversification to an investment portfolio. There's obviously some unique risk-reward characteristics offered by an index annuity. If you're creating a balanced portfolio, it could be interesting in terms of reducing your standard deviation and providing a better risk-adjusted return to your clients by considering an index annuity. But again, an index annuity is not an equity market alternative. I don't suggest it being sold as one. People have gotten in a lot of trouble doing exactly that. The industry itself got into a little bit of hot water, which is why we have increased regulation, scrutiny, and compliance issues. So please do yourself a favor. Do not sell it as an equity market alternative. Sell it for what it is, which is a fantastic vehicle to earn funds on a tax-deferred basis and be able to potentially get that income for life. So with that, I'm going to turn it over to Jessica, and she is going to talk a little bit about the products that are available today and some of the ones that you might want to consider. And Jessica, I just unmuted your phone, so you should be able to speak.
Perfect. I was just going to ask you to do that. Can you hear me okay? Yeah, good. Okay, perfect. Like Lloyd said, and Lloyd, if you want to jump over to my list for me, I'm just going to be talking.
So Jessica, sorry.
Oh, yep.
Yep, continue on, sorry.
Okay, no problem. I'm just going to do a quick review of the top 6 annuities. And when I say top 6 annuities, I mean that our agents are currently selling. There we go. So you should see the list now. I'd say these make up about 80% or so of our index annuity sales as Gateway. So certainly, like Lloyd mentioned, a ton of products out there. Are other products you can be writing. These just happen to be the ones that our agents are writing the most of. So we just kind of want to highlight some points of those. So for the Reliance Standard Keystone 5, it's going to be a great choice for an index annuity with a shorter surrender period, it's 5 years, and a good cap rate. It's currently at 3.7% on the annual point-to-point account, with a 2% guaranteed cap. Without the bells and whistles of income riders and bonuses, this product actually focuses on short-term accumulation for your clients. So if you're looking for an alternative to a CD, this is going to be a good index annuity for you to consider. Genworth's Secure Living Index 7 is an index annuity that can offer your clients guaranteed growth even in an extended down market. So with a 107% guaranteed minimum accumulation benefit over those 7 years, strong caps, they're currently at 5.75% for premiums over $100,000. Again, that's going to be on the annual point-to-point. Performance trigger account option, like Lloyd mentioned, and a bailout feature. This product is ideal for clients focused on accumulation of their annuity. Then we're going to skip into Allianz, two products specifically. When it comes to income riders, and I don't want to say for all clients in all cases, but when it comes to income riders, that really is Allianz's focus. So the Allianz MasterDex X is going to be a great choice for an index annuity that offers strength in both the accumulation factor and the distribution of income. With a 7% premium bonus for all premium in the first 3 contract years, competitive caps and renewals, which Lloyd mentioned is very important, and flexible income options, the MasterDex X is an ideal product for younger clients looking to begin taking income in 10 plus years. So we're talking at least 10 years of deferral. Then we're going to skip into the Allianz 360. I want to make sure I note that this is only available on their preferred contract for Allianz. It's not available on the standard contract. I do encourage you to talk to me to see if you'll qualify. It's a great product, especially for income, but like I said, as is the MasterDex X. On the Allianz 360 annuity, though, with their 360 benefit, which is that income rider, it offers a powerful combination of income-building features that gives your clients opportunity really at every turn. So clients have the opportunity to receive an interest bonus equal to 50% of any interest credited to their contract until lifetime withdrawals begin. For example, if the index credits 4% one year, they're going to get a 50% bonus and actually get credited 6% that year. And they have the opportunity to increase their lifetime income withdrawal percentage for every year that they hold their contract in deferral. So Lloyd mentioned those step-ups and withdrawal percentages, This product specifically goes year by year. So with 2 different lifetime income withdrawal options and a new uncapped account with a low 2% spread, this product is going to be a good fit for clients looking to maximize their income down the road. Jumping over to North American, their Charter 10 is an excellent choice for clients looking for a flexible premium index annuity without a rolling surrender charge. So this product has a 5% premium bonus on all premiums received in the first 7 contract years. Offers a great alternative to a single premium index annuity. Currently has a 3.5% cap, so really is ideal for people with long-term objectives who are going to be comfortable with that 10-year surrender period, a little longer. And then lastly, I just want to touch on some notes on the Great American Safe Return. This is going to be a great choice for an index annuity for your more conservative clients. It offers 2 separate forms of protection. One is going to be a return of premium guarantee to ensure that their money is protected. And the second is a bailout feature to help protect their opportunity for growth. That bailout feature means they set a specific cap where if the cap, when it renews, is below that bailout cap, the client can actually get out of the policy without suffering any surrender charges. Great for protection and, like I said, conservative clients. It features a 10-year surrender period with strong caps, currently at 5%, again, that's on the annual point-to-point. And it offers 3 additional riders that focus on your client's income or death benefit needs. Like we mentioned, the income riders, obviously a great benefit, but on this death benefit rider as well, I want to focus on that with this product. It's the inheritance Enhancer. It's a death benefit only rider that offers a 9% roll up for 10 years. This is going to be ideal for older clients with assets that they don't plan to spend, or even for clients who might not qualify for life insurance. This particular rider could still offer a fantastic death benefit option for those clients. So that's just a quick overview of our top 6 selling index annuities. Of course, it's important to remember that there are subtle nuances in the products and their riders that are going to make each of these ideal for different client needs. Therefore, it's going to be best for you to get an understanding of exactly what your client is looking for, including their death benefit needs, their income needs, including when they want to start taking income, what length of surrender charge they're comfortable with, of course, their current ages, etc. So we have a really good idea of what your client's goals are with this annuity. Once you have these details, I do encourage you to give us a call at Gateway. We can help you navigate through the different products and riders and really determine which is going to be the best option for your client. And my last note, I got a request from my contracting team to give you guys a plug. If you are getting appointed for annuities, please make sure you're submitting your annuity certification for us. It's going to make it easier for us to get you appointed. And then again, just feel free to give me a call so we can start working through these products and figure out what's going to be the best fit for your client.
Great, thank you, Jessica.
Lloyd? Yeah.
Yep. You're back to me, thank you. So thanks, Jessica. That's just a few of the more featured products that we have available. We've got probably about 20 different carriers, well over 100 different products. If we're not talking about a product here that you're interested in, let us know. We probably have it. We try to do some screening of the products that we talk about. We want to make sure that they're high quality carriers. We want to make sure that they have good renewal rate histories. These are the important things that, in my opinion, differentiate carriers from other carriers or products from products, much more so than is someone using a cap rate versus a spread or a participation rate. So we try to look fundamentally at the carrier to say, is this a carrier that we want to have our clients' assets, tied up with for the next 10 or 15 years? But at the same time, if you've got another carrier that you're interested in, let us know, and we'd be happy to give you all the information on that. So we have various software available. This is kind of an answer to a question here. We have lots of software in-house that we used for both fixed index as well as deferred annuities, which can show you all the differences between the different products from carrier to carrier. We'd be happy to provide that information to you. And on our website, we do have spreadsheets available where we are constantly updating which of our annuities we think are most competitive. But again, every client is different. We were looking at some income riders earlier this morning, and in one case, if the client wanted to defer taking income by 10 years versus 9, it completely changed the carrier and product that we recommended. So, if a client is 60 versus 61, those very small changes might greatly impact the carrier that we recommend because of a small nuance in how their rider has been constructed. So it's critical that you talk to us, and we'll make sure that we steer you in the right direction. But yes, we do have some materials that we can give to you so you can do some homework on your own. Let's wrap it up by doing a quick summary of 10 fantastic reasons to buy an indexed annuity. First of all, safety, right? No stock market fluctuations. The principal is guaranteed. There are interest rate guarantees as well. We talked about tax deferral. All the interest in a indexed annuity, like any other annuity, is on a tax-deferred basis. The yield, very attractive when we compare, especially to CDs and short to medium-term bonds right now. You can get a very, very competitive return for your clients using an index annuity versus perhaps a CD or other alternative. Every CD has free withdrawal features, very common, 10% per year. Oftentimes today, we're seeing annuities with nursing home and terminal illness riders as well, allowing clients to take out additional funds in the event that they need nursing home care or have been unfortunately diagnosed with a terminal illness. Of course, any death benefit paid upon the death of the annuitant is done so outside of probate directly to the beneficiary. There's no sales charge involved, no expense charge on an annual basis for having an index annuity, which might be a little bit different from variable annuities for folks that are used to selling those. But there are no annual expense charges. There are, of course, charges for writers in most cases, but 100% of the premium that the client pays is going to the account value and will earn whatever index credits are available at the end of the time period. There's lots of flexibility and control. We've talked about numerous options, both for contributing, whether it's you're looking at a client for a single pay or you're looking at a client that wants to make contributions over a multiple number of years, as well as the payout options involved. Diversification, I talked about this very briefly, about indexed annuities offering a very unique risk-reward profile. So it might be a wonderful addition to a portfolio when you're trying to manage your return on a risk-adjusted basis. We've talked about the guarantees. The premium is guaranteed. There's always a guaranteed minimum rate. And whether it's a cap rate, spread, or participation rate, there's always guarantees involved with that as well. And most importantly is the guaranteed income for life feature, which is, in my opinion, what makes index annuities so attractive. Take advantage of these riders so your clients don't outlive your income. So this is the last time to ask a question. We are wrapping things up at this point. My suggestion again is to give Jessica a call when you have a case. Find out as much as you can about the client. We'll steer you in the right direction. We have lots of material available that we can send to you if you'd like. We have lots of tools in-house, including various spreadsheeting tools, income projection tools, so we can compare like income riders from one product to another. Take advantage of us. We're here to help you. If you have any questions following this, please give myself or Jessica a call. We appreciate your time and have a great rest of the day. Thank you.